welcome back to my favorite channel. Right now, I want to say about investors' behavior is expressed not only in chart patterns. Investors' behavior is expressed not only in chart patterns, trend formations or sideways markets, but also in peaks and valleys. Every peak or valley is an indication of what the majority of investors expect at any moment in time. Intraday peaks or valleys, however, are not as meaningful as those on daily or weekly charts. Our analysis, therefore, focus on daily data, but it may easily be extended to sets of weekly data. Whenever traders are looking for a good entry point to buy long or sell short, they want to come as close as possible to important turning points in the market. If they stay close enough to the market actions, the stop loss level is not too far away from the entry point. On the other hand, the profit potential is big enough to participate in longer market trends. Trading rule significant peaks and valleys in the market are much more relevant than often assumed. Trend channels are generated by establishing major peak-to-peak and valley-to-valley connections out of regular 3-wave or 5-wave market moves. This is why trend channels should be the primary step when analyzing markets. PHI channels are improvements over regular trend channels and are generated slightly differently. Our PHI channel analysis work with baselines as connections of significant high to low and low to high formations. PHI channels can be drawn either from impulse waves or from corrective waves by determining the outside parallel line of a PHI channel on the basis of the next significant peak or valley to the right on the baseline. As soon as a PHI channel has been established, the width of the PHI channel measured as the distance from baseline to parallel line can be multiplied by the ratios 1000, 1613, 1618, 2618, 4236, and so on, as shown in chapter 3. Depending on whether the baseline of the PHI channel is trend following or counter trend, it is possible to draw PHI channel trends lines or PHI channels resistance lines in various distance from the outside parallel line of the PHI channel. Combinations of PHI channel trends lines and PHI channel resistance lines create a spider web. 109 designed for mapping market price actions and predicting future market moves. In a trending market with more than 3 waves upward or downward, the baseline is adjusted to the most recent high in an uptrend or the most recent low in a downtrend. The outside line has to be adjusted to peak or valley on the right side. Entry signals on PHI channels are generated when the outside line of the PHI channel and the most recent peak or valley are broken. The sample concepts the sample This, this simple concept works well to define long or short market entries in many markets and products because the entry signals are generated after a failure in the price move. The peak or the valley that turns out to be a failure can occur either before or after the outside line of the PHI channel is broken. We receive a valid entry signals in both cases. The stop loss level, as discussed throughout this chapter, is the most recent peak or valley in a loss after the sell signal or buy signal has been generated. This rule is illustrated on a short positions in figure 446. Once we are stopped out, we have to wait for a new entry point. Once we get stopped out, we have to wait until the market moves out of the trading range. We buy or sell as soon as the closing price C trades above or below the peak or valley that marks the upper or lower border of the trading range. Until here first for today, see you in the next video. Bye.